All right, guys, I'm going to do a risk management overview today. I'm going to be walking through a simple model that illustrates the math based off of, account size, win rate, risk to reward, everything you see on the screen here. Before I get started, I'll start by saying I think there's a misconception in trading where you put this pressure on yourself to be right or to win every trade. And I don't know how many times I had to learn it. I don't know how many times somebody that might be listening to this has gone through the same thing. You're going to experience a loss. You were going to lose. You're human. It happens. And the market does what it wants. We are simply trying to do our best job at creating a higher win rate than loss rate. But what I'm going to walk you guys through today illustrates mathematically how you can have a losing record, a significant losing record, and still be profitable. So just remember, you're not always trying to hit a home run. We're looking for singles, doubles, triples, home run when we get them, with a high batting average. And as I walk through some of this math for you, that'll start to picture itself pretty clearly. So here we've got an example of somebody with a 30% win rate. I'm going to start by using a $5,000 account size. Might be a little large for some of you, might be a little small for some of you. I thought it was a good number to start with right in the middle, to show somebody who maybe is newer to trading, or maybe they've been doing it for a little while and don't want to throw too much money at the market. So this model is going to show a 30% win rate, a risk to reward ratio, or reward to risk ratio of 3 to 1. So for every dollar risk, we stand to gain $3. Risk per trade is going to be 2%. That's going to be based off of the account size. So you can see our average win will be 300 and the average loss will be 100. 100 is being based of 2% off of 5,000, and then times 3 is getting your average win of 300. So if we come over here to the left side of the screen, right, we're going to win 30% of the time. This is based on 10 trades. So you can imagine that is maybe you took 10 trades per month, or maybe you're taking 10 trades per week. However you want to scale this, right, in your mind, or however it matches up to the way you trade, you can rinse and repeat this formula. I use 10 as a nice easy round number. And to be honest with you, 10 trades in a month is really all you need to be making some serious money. And if I go a little bit deeper into this, you'll start to see why. I've also assumed this is over the base of a month so that we can give a monthly percentage return. So 3 out of 10-year trades are going to be wins. Your average profit per trade is going to be $300 because we've got a 3 to 1. And the subtotal of that's going to equal out to be 900. As you can see, without even looking to the right side, peeking down here at the net profit, you're still making money. You're still profitable with a losing record. And this is that's really low accuracy, in my opinion. You're almost losing 3 trades for every 4 that you take, right? So that's a really low accuracy rate. And most people, even newer to trading, are probably closer to about 50-50, if not higher. So this is, again, assuming 70% of those trades are going to be losers. 7 out of the 10 are going to be losers. Average loss is $100, and the subtotal is 700. So with a significant losing record, you are still going to make $200 in a month. Now the second, again, this is modeled off of a 3 to 1 risk to reward ratio. So the second that you start to mess with that, or maybe you're taking profits a little early and not letting them run out 3 to 10, this model will start to get skewed. So wanted to point that out. This is going to yield in a 4% monthly return. So not bad for, and this may be shocking, right? For somebody who's going to be very low accuracy, you can still make money. 4% monthly stacks out to, quick math, 4 times 12. Is that 48%? 48% on the year. All right. Banks are offering their clients or trying their hardest to get 1 to 2% a month. If a bank can offer 20% a year to somebody, that is substantial. All right. So you're more than doubling that just by having a losing model. Okay. So we're gonna talk through at the end how to frame these higher risk or higher reward to risk trades. So we'll move on to another example. All right, same account size, 5,000, but we're going to say the win rate is 50%. Simply winning 2 more trades and losing 2 less trades. Same reward to risk model, 3 to 1, still risking 2%. Average win, still 300. Average loss is still 100. So that will yield you $1,000 net profit per month on a $5,000 account. All right, what would that do for you monthly? You're wrong half the time. You're still at a break even from an accuracy rate. You are break even. You're flipping a quarter. You're right, you're wrong, you're right, you're wrong. This 50% right here takes almost no skill. You could do this without any sort of method, with just looking for, if you were a supply and demand trader per se, and you didn't know anything about ICT concepts or the strat, if you simply just framed your trades off of buying in a discount and selling in a premium, you could probably do better than this without even knowing what you're doing. And you are going to profit 20% monthly return. All right, this right here is what everybody should be striving for. 20% monthly return compounded is significant. Now, I should have done the math. I'll let you do that on your own with your own account size, but with a $5,000 model, if that compounds, this 1,000 turns into 10,000 pretty quick per month. It might take you a year to get to that point, but in the grand scheme of things, if you could be making a 6-figure income doing this with a 50% win rate, starting with $5,000, I'd say a year is not too bad, considering most people go to college for 4 to 5 years and they're not even guaranteed income or any sort of job, let alone 6 figures. So we're going to move on. 20%, again, this is the target. Anything above that's awesome. You get 20% a month, you're averaging 240% annual return. That's insane. You know, let that sink in. What's 240% times 5? 5,000. Right? That's 12,000. So you're turning 5,000 into 12,000 over the course of a year just by having a 20% monthly gain. All right, now let's scale it up a little bit more. Let's say that you get to the point where you're starting to frame trades pretty well. You're letting them run out to 3 to 1. And again, this is all modeled on every time you take profit, it's at 3 to 1. Every time you take a loss, it's at 2% risking your account. Right? So you're standing to make 6% on the account, you're standing to lose 2%. If you start playing with, trimming positions and scaling yourself on the way out, there's nothing wrong with that, but this will alter the results you're going to see. You're not going to see the exact model that's represented here. So let's say that instead of winning 5 trades out of every 10, now you're winning 7 and you're only losing 3. Average profit still the same. Average loss is still the same. But what happens is we go from making $1,000 a month to almost double that, $1,800 a month, or 36% monthly return. This is absolutely phenomenal. $1,800 on $5,000. If we scaled that to $50,000, guys, that's $18,000 in a month. All right, and I'll talk through in a minute about if you don't have that kind of capital, how you could potentially come across some kind of capital like that without a lot of risk. So we're going to move to, let's say, a lower reward to risk ratio. Maybe you can't hold it out for 3-to-1. Maybe you're having a hard time just holding it out past a 1-to-1. Right. So let's scale it down to 2-to-1 reward to risk. Now we've changed up some percentages and some numbers on the right side. So I'll walk back through this. We've still got a $5,000 account. Our win rate is going to be a losing win rate, not even 1-to-1. It's going to be 40% win rate, 2-to-1 reward to risk. Risk per trade is now 3.5% versus 2%. Maybe 2% was a little conservative for some of you guys. Maybe you want to risk some more. So we're going to go up to 3.5%. Average loss, 3.5% on 5,000 is $175. Average win is going to be 350, right? 175 times 2. So if we look at our win column here, we can see 40% winning 4 out of 10 trades. Average profit is going to be $350 per trade. That's going to equal a subtotal of $1,400. All right. Now we're losing more trades than we won, 6 out of 10. Average loss is 175. Subtotal being 1,050. This is still a 7% monthly return, $350 profit on 5,000. Now it's not life-changing money, but 7% should be eye-opening. 7% per month, guys. There's millions and millions and millions of dollars out there that don't know this, that don't know how to leverage the market, that would kill to see a percentage return like this monthly. This is literally hitting a couple singles, maybe 2 singles a week. And what I mean by singles is I'm referring to baseball terminology, right? You're not trying to hit home runs. You're trying to take some little stabs at it, get in, get out. And we're not trying to do the, hold it for a week, 1,000% return. It's very unlikely to repeat those. And in all honesty, if you're averaging 1,000% return, I'd love to talk with you. But there's nothing wrong with 7% monthly. And again, there's so much money out there where people would be willing to give it to you for your services to create a 7% return. All right, so let's move to a winning rate. What happens when I flip the numbers here? When I go, everything on the right's the same. We're still 2-to-1. We're still 5,000 account size. We're still risking 3.5%. We're averaging 350 win rate. This is all the same except for our win rate. We simply went from 40% win rate to 60% win rate. So now we're on the a positive side of the win rate. Look what happens to our net profit. We go from $350 a month in profit to $1,400 a month, all the way from 7% to 28%. As we're only looking for a 2-to-1, that's pretty low. 28% a month, like I said, that's 8% higher than what your ideal target monthly should be. This right here will create millionaires very fast. All right, so I'm gonna let that sink in a little bit. I'm gonna go back one slide. $350, all we did was go from a losing win rate. We got a little bit smarter, a little bit stronger in our confidence of the strategy we're using. And I'm not saying you got to use the strategies I use. Risk management is more important than the strategy. All right, and then you got to factor in patience, which allows you to get to your 2-to-1, 3-to-1. But let's say you started studying more and you realized the potential that trading could provide for your financial future, for your household. All right. If you get a little bit better at it and you start to get from 40% to 60%, it quadruples the amount that you're bringing in. All right. So let's scale up a little bit here. Numbers have changed a little bit. We're going to start showing somebody who is maybe a little bit more risky. They've got more risk tolerance than most. And you're noticing I'm not saying we're risking 10%, 15%, 20%. If that's really what you all want to do, the way a 5% loss means you got to make a 10% gain the next day. We're not trying to, you know, put all the money on black or red and trying to double it. A lot of you guys might have that. I know I did, and I'm not trying to make assumptions, but when I came into this, I said, man, I could take a couple $1,000s and double it back to back to back, and I can keep doing that, right? I mean, you only see the upside, and the point of this lesson is you need to respect the risk side of the trade more than the profit side of the trade. Right. Now, I'll get off that high horse, but that I really, hopefully that sinks in and opens your eyes a little bit if this is something you're struggling with. So we've got a $50,000 account value here. Our win rate, not even a positive win rate. We're still break even, right? 50%. 5 wins, 5 losses out of 10 trades. Risk to rewards 2 to 1, not even 3 to 1. Our risk per trade is 5%, right? So this is a little more aggressive. We're risking $2,500 per trade on 50,000, which makes our average win 5,000. Okay. Net profit's going to be $12,500 a month. Guys, he just became, 6-figure income very fast with this. 25% monthly gain. When that starts to compound, this number gets a 0 behind it pretty quick. This will, I don't care who you are, that's going to change your life. This number alone, what would that do for you? If you get a check in the mail for $12,500 every month, what would that change in your life? On top of what you're already making. Or maybe you could replace the job that's bringing this in. Maybe you could buy your time back. All right, and now I will start to explain how you could, if you don't have $50,000, and you do feel that you can produce a 50% or higher win rate, I would probably strongly suggest not looking at getting a funded account or applying to become a funded trader. And I'm not going to advertise for different programs out there. I've got no affiliation with that. I'm not getting any sort of kickback. So, you can do your own research if this is something you want to look into, but you can prove yourself as a successful trader based off of certain targets and objectives. And if you do so, they will give you $50,000, $100,000, $150,000, $200,000 to trade with. Right now, there's going to be parameters where they're probably not going to give you a 5% daily drawdown. So you're going to have to play with this model a little bit to see what you could make off of 50,000. But if that's something you want to look into, you don't have to risk your own capital. You don't have to go take out a personal loan or a HELOC on your house, or right. You don't have to over leverage yourself with a ton of money and put your capital at risk. You can use someone else's once you've proven to be a successful trader. Now, there are costs associated with that. There are monthly costs or one-time costs, or maybe if you wanted to talk with a relative about an inheritance or some sort of loan and you gave them back an interest rate on their loan, you guys can figure out how to come up with more money if this is something that seems appealing to you. But the point is you're not even in the green here. You're wrong half the time, and you're making $12,500, 25% a month. All right, so I'm going to go over to a larger size account. This probably won't be something that hits home for most people watching this. Now, this, again, if you're going to go funded style, this is an amount of money that you can get funded for, and it's not unrealistic. There's a lot of people out there who create their wealth by doing this. And same model, right? The only thing we're changing here is the risk per trade. We're going to go 2% instead of 5%. Our reward to risk, is 2 to 1. Win rate is still in the black. You're not even at a positive accuracy rate yet. Okay. Average loss is going to be 3,000. It's 2% of 150,000. Average win rate is going to be 6,000. All right. So running through the same model, Net profit's going to be $15,000 a month or $10,000 a month. You could literally be using someone else's capital. This isn't even your capital, right? You've proven yourself to be a profitable trader, a successful trader. You're not even really good at what you're doing yet. You've got a negative, not a negative, but you've got an even win to loss rate. And you could be making $15,000 making someone else. And this is all hypothetical, guys, right? This is holding it out. This is a perfect model, which we're human. That doesn't necessarily exist. Maybe you're not going to hold each trade to 2-to-1. Maybe you've got a problem with having a hard stop loss. Maybe you can't see minus 3,000, right? Again, it's just a hypothetical model, but the point is to show you the math of you don't need to be winning 90% of your trades to be profitable. You need to manage risk good. You need to take good reward to risk ratios. Every model I showed, I didn't go above a 70% win rate. And you saw the kind of return that was being offered, right? So this is the last example I'll show. This is going to be same thing, $150,000 account size. Our win rate went up 20%. Now we're winning 7 out of 10 trades and only losing 3 out of 10. And our risk per trade is still 2%. We're still only going for 2-to-1. 2-to-1 is not that hard, guys. You know, when I walk through some models, if you follow the way I trade, the ICT concepts, 2-to-1 is basically a lock in every trade you're going to take, for the most part. And then when you start getting good at, you know, understanding institutional sponsorship and how the trade will be with you, not against you, that 2-to-1 can turn to 5-to-1 or 6-to-1 if you've got the patience to hold it out. All right, so simply going into a green or positive win rate, right? 70% is pretty good. I average about anywhere from 70 to 80% win rate. So this is kind of where I would be hanging right here. You know, you've got some break even. Break even would be right here. Maybe your 70% win rate, 10% break even, 20% loss. It'll alter the model a little bit. And my goal isn't to continue to give hypotheticals. You can take this model, you can plug your own numbers in, and you know, hopefully you're tracking that data of, all right, how many am I losing per month? How many am I winning per month? Why is that? Do I have a model? Do I have a strategy that I'm following over and over again? Am I disciplined? Right? Am I reviewing my trades? Why did I lose? Why did I win? Those are all things that should be known before even considering this. But the point is these are some pretty big numbers down there. This is absolutely life-changing money, right? I mean, that's $500,000 over a year. 33. Yeah, it's a little shy of $500,000, right? But what would a $33,000 check per month do for you, or 22% gain using someone else's money? Right? That would really start to change some things. I imagine you could quit your job. I imagine your significant other could quit their job. I imagine you wouldn't feel the pressure of making your bills that month. This right here is the goal. This right here is financial freedom. And the other examples I showed is also financial freedom, right? The example of having a 10% win or a lower account size with a little bit higher percentage win rate, or just taking a higher reward to risk ratio. You can play with the numbers, but the model is to show you don't have to be super exact. And following somebody like the people we've got in Lucid Investing who are very precise, who have high win rates, this only increases your chances and your profitability if you're managing risk correctly. Right? So it's absolutely, almost every profitable or extremely successful trader has partners. They have accountability partners, people who maybe they're not taking alerts, but they're taking a second opinion. That's completely normal, guys. That's how I started. That's how anybody who's in this industry does. You don't have to be the one that's right. You don't have to take the glory. All right. And if you can follow along people who've got a really high win rate and you're starting to agree and see why they're taking those trades, this is your financial freedom. All right. So I'm going to go over to what a risk to reward model or reward to risk model looks like. So here I've got a screenshot of an example of a trade that we would take. And this is hindsight's 2020, right? But this is absolutely something we would have been part of. This is something I would have alerted, something that we in Lucid Investing look for. You've got a break and sell side liquidity with buy side liquidity or the target identified. Once we've broken our swing high right here, you can see we retrace down into an order block. None of this makes sense to you. You can look at some other courses or reference ICT. We do have courses as well, but the point is to not show you our model. Point is your entry on a very conservative entry would be the top of this red line where minus 1R meets 1R. All right, these blocks are going to identify our segments of profitability or risk or reward. Okay, so obviously minus 1R is going to be the amount that we're risking here. I've got that entry at the very top of this order block. All right, so you could have entered here, you could have entered right here 3 different times, could have entered here. As you can see, the stop would have been below this low right here, or if you were super conservative, maybe below this low. In some instances, if you were too tight of a stop, this would have changed the model. If your stop would have been right here, this would have been more of a 10-to-1 reward to risk. You would have been stopped out. All right, so let's assume that you managed risk properly and you said, hey, I've got, let's say 38.60 right over here on the right side of the screen was the entry. That's where my buy order was. When price retraced back into this level, I'm going to buy, my position to go long at 38.60. And my risk would have been down here. Let's call it 38.54. All right, that's 6 handles. That's really, that's nothing. All right, so 6 handles on an E-mini contract equates to $300. All right, so if I were to use this is where your contract and your position size, how many contracts am I taking? This is how you figure that out. Okay, so if I said, all right, well, I can risk, $300 per contract here if I'm trading an E-mini, or maybe you're trading a micro, right? And a micro in this instance would be a $30 risk per contract. And let's say my account size, let's pick one of the models I went through. Let's say for this example, it was the model where I'm not risking more than $100, right? I've got a 2% max risk per position. I've got a $5,000 account, so I can afford to lose $100 on this trade. I can lose $30 per contract. That means I can take up to 3 contracts, 3 micros for this example. All right. So I've already determined my contract size based off of my risk, and I can clearly see where my profit targets are going to be. Okay. So one profit target would probably be, this would be your first trim, right? Because we're using swing highs. Where is liquidity residing? Where are the buy stops residing for people who are short? They're going to be right here, right here, right here, right here. Okay, so you can see how our first trim puts you right at that 2-to-1 reward to risk model. There's no reason to have taken profit, and you would have watched this as well. You probably would have even made it to 3-to-1 before you would have even closed out. Okay, and then you see price retrace after we take out this liquidity, these stops right here, and then we go for another run to 5R. So in this example, right, the way I would trade is if my goal was to get to 2-to-1, and this is where things are going to differ for most people, right? The goal was 2 to 1. And that's all I was trying to do. In reality, you should have had your limit sell in a buy position right here at the top of the 2 to 1 for all contracts. Boom, you hit your goal. Good job. Right? You successfully achieved your mission. Now, let's say you were very confident that we were going to continue higher right here. You could trim half of your position, or in this case, that we've got an odd number of contracts. Let's say we're going to trim 2 of them. All right, 2 of them are gone at 2 to 1, and we're going to let that last contract run for the 5 to 1, right? Which in turn would basically double your position size, if not more. I'll let you guys do the math on that. Where would your stop be once you trim right here? Break even. We move it up from our risk. Now we've got house money, and you can afford for this to come all the way back down. Or even if you want to be more conservative, put it above one R. Right? I mean, you guys can look at this in terms of percentages. If I'm risking $100 here, and each one of these boxes results in an additional $100, you could say this is 100% return right here. This is a 200% return right here. This is a 300% return right here. 400, 500. Right? So it's up to you. Where do you want your stop? For me, if you're going to stay aggressive and you're going to go for a full target up here, which you cleanly hit, again, hindsight's 20/20, but if that was your model here, you'd move your stop to where there's no way you're going to be losing on this trade, right? You managed risk very properly. You didn't quite achieve a 2 to 1, even though you trimmed most of your position here because you let the other 33% of your contract size stop out at break even. You would have been closer to 1.5 R, maybe 1.7 R, something like that. At the end of the day, you still made money and you manage risk properly. So I hope y'all found this helpful on how to walk stops up. There's other ways to do that. But the point of this is you don't need to be right every time. Take that pressure off yourself. Stick to what you know. Back test. Reflect on what you're doing wrong when you do take a loss. And sometimes there's nothing there. Sometimes you take a loss and you can't identify it. That's why you should be absolutely in a group setting so that you can have other eyes on it. All right, we offer that at Lucid Investing for those that are already in. And we hope to see you guys until next time.